Hello and welcome back. I'm Martin Mühleisen, a senior fellow at the Atlantic Council, and I'm here with Bayoumi and Tianlei Huang. We're discussing whether there's anyone left to save the global economy. Now, that's a provocative title. What it means really is we want to look at the fortunes of the largest economies here in the world, especially the United States, China, and Europe. And we're going to discuss a little bit the interactions between those and what it means for global growth going forward. But let me first introduce, to my right, Bayoumi. He's a former deputy director of the International Monetary Fund, where he worked for over 3 decades on macroeconomic policy, surveillance, and global financial stability. Tam, you've led major divisions at the IMF, including the one producing the World Economic Outlook, and we both have worked together on crisis management and policy coordination within the G20. You took some time at the Peterson Institute to write a well-known book about the 2018 financial crisis, and you're currently a visiting fellow at King's College London.
Yes.
Tianlei Huang, you coordinate the China program at the Peterson Institute for International Economics. Welcome. Your research focuses on Chinese financial markets, on state-owned enterprises, and global economic relations. You worked at Johns Hopkins, SAIS, at the Brookings Institution, the Hudson Institute, and you hold advanced degrees from Tsinghua University and from SAIS. Welcome. And well, let's get right into it. Tam, what's happening with the US right now? What's the kind of the medium outlook, if you want? And they're expecting a lot of growth coming out of their investments now that go into AI and crypto and other investments. Will they be a locomotive for the global economy despite the tariffs?
Well, I think that's the million-dollar question. The way that this is often stated is there a bubble or not? And I actually think that is the wrong way to think about things. The reason for this is, when you have a breakthrough technology like AI, you always have these sort of sudden moments when there's a lot of investment. It's sort of part of the creative destruction that these technological changes have. So there's clearly value in AI and in crypto or whatever. The question is, nobody knows quite how much. So in a sense, we're in a sort of quantum moment when there's a lot of uncertainty about what the real situation is. But that has 3 implications, I think. The first, for the US economy, let's start with that over the medium term. The first is that there is value in AI, so all of those data centers and that investment in AI technology will pay off. The question is how much, not whether it will. So that sort of bubble is the wrong term. The second is, this is being financed largely in the equity markets, and you get into real financial trouble when you finance things with banks, not with equity. And the third is, these are companies, by and large, that a few years ago we were wondering how they were going to spend all their money. So the fact that they're investing a lot is sort of not really the worst thing you've ever heard of. So in terms of AI, I think prospects for the US are highly uncertain, but probably not a sort of real big crash of the 2008 variety is unlikely. Turning to trade, there are 2 interesting things to note about trade compared to what everybody thought 6 months ago, or most economists thought 6 months ago. The first is there hasn't been a lot of impact on inflation, and the second is there hasn't been a lot of retaliation outside of China and rare earth and all of that stuff. I think that has 2 implications. Now, it could be that inflation is still in the wings, that everybody's waiting and they'll do the price hikes once things have settled down. But another possibility is the US market's so important there's actually more market power than we thought. And that brings me to a second thought about trade, which is this lack of retaliation. And maybe we should be thinking about this as an optimum tariff rather than an optimum tariff sort of argument, in which case the question is it may do the US at least not too much harm and maybe some good, but it won't help the world economy. So I think that's a way of thinking about tariffs. Finally, there's the US fiscal, and obviously the US fiscal, there's a high deficit. I think that that is the worry in terms of the fact that if anything does go wrong in the world economy, there's not a lot in the in the bag if things go wrong. But at present, the focus, I think, is on smaller countries like the UK or France, and I think that's probably right. That the chance of a real fiscal issue in the US is probably lower than some people seem to think.
Yeah, although of course the projections are pretty pessimistic when it comes to debt, right? From the CBO.
Well, as I say, there's still a lot of debt coming. Yeah. The question is, and again, this is not unique to the US.
Yeah, that's right. Tianlei, China. It's a big puzzle sometimes in some respects because it is very strong in exports at the moment. Everybody is afraid, in a way, of being outcompeted by Chinese manufacturing. But there are different voices about the underlying strength of the economy. Housing bubble, domestic demand. Can you explain to us a little bit how you see it and what you think kind of the medium trend is for the Chinese economy, and how will they benefit the rest of the world with their growth?
Sure. First of all, it's an honor to join you and Tam on this occasion. Very happy to be here. Well, the Chinese economy is obviously in transition. It's transitioning away from the quote-unquote old economy, which relies heavily on housing and infrastructure development, to a new economy, which in the vision of the Chinese leadership is led by high-tech manufacturing, innovation, and decarbonization. And the Chinese leadership obviously also hopes that by focusing on the new technologies, the emerging new economy sectors, that the Chinese total factor productivity can be pushed up, and which can help China sustain growth over the long term. Now, the problem, at least for now, is that the new economy, even though it's developing very fast, it's still not big enough to fill the vacuum left by the old economy, which is falling apart rather quickly, especially with the bursting of the housing bubble. So I think what that means for China's medium-term growth outlook is that we'll probably see China's growth continue to be sluggish. The kind of double-digit growth that we saw in the past will just never come back. Now, I also want to say something about demographics. I think China will probably continue to see its population age and shrink, and the increases that China announced in its statutory retirement ages last year will have some positive impact in terms of offsetting the drag from a shrinking workforce. But I think that positive impact will be very limited because there's substantial flexibility built into the retirement age reform. Well, the good news is that human capital in China is improving. We see education attainment of the Chinese population is growing steadily. But a worrying trend, at least to me, is that female labor force participation in China is actually dropping very quickly. You see, in many advanced economies, the gap between male and female labor force participation is actually narrowing. That gap in China is actually widening. While you see more and more highly educated women dropping out of the workforce, perhaps because of family, perhaps because of workplace gender discrimination. In any case, this is not a good news for China's growth prospect. Now, Tam talked about fiscal in the US. Let me also just say a few words about fiscal in China. We know that for the past 20 plus years, local governments in China have relied heavily on selling land and collecting tax revenue from land and real estate developments as a major source of their fiscal revenue to do infrastructure construction. Now, with the housing market in China peaked in 2021, has been declining ever since, that major source of revenue is now collapsing. We see land revenue has dropped significantly in the past couple of years, and with deflation as well, other tax revenue that the government is collecting is also shrinking. Now, the problem is that with less revenue, the Chinese local governments are spending less. So this pro-cyclical response is actually exacerbating the deflation problem that China is facing now. Now, faced with this reality, we see an interesting development in recent years, which is the Chinese central government is now embarking on a path of fiscal expansion. China's budget deficit this year, the headline budget deficit this year, is the highest on record. Well, this year is also a little bit special because the central government this year issued $500 billion in special treasury bond to recapitalize the big banks. The big banks are obviously facing huge troubles with the bursting of the housing bubble, and I think China is learning lessons from the experiences of other economies in dealing with the fallout in the financial system after the bursting of the housing bubble. They're not complacent. But in any case, I think this trend in terms of central government expanding while local governments are stagnating or even contracting will likely continue for a while.
Let me ask you, because again, we're thinking about the impact on the rest of the world, right? Now, we know that Chinese exports are expanding quite a lot. And let's not talk about subsidies so much. We know that they're there and they're a big issue in the trade negotiations. But just as a fact, so exports are increasing, the surplus going up. But is this also is the surplus also getting bigger because imports are kind of lower? I mean, there's this tendency in China toward this dual circulation, but one wants to become more and more independent. A lot of investment in renewable technologies for energy mean less oil imports and the like. So do you see that China is also becoming less of a motor for the global economy?
I think that's true. I mean, China's trade surplus this year is, again, a record high. We were seeing this repeatedly in news headlines in recent months. It's both because of exports. Chinese exporters are actually, I would say, amazingly resilient. Despite the very high U.S. tariffs, they have obviously found new markets beyond the U.S. But at the same time, you see China's imports are actually declining. That's why we see a record high trade surplus. And this is, to me, just simply not sustainable and not the good news for the rest of the world, even though it shows the resilience of Chinese exporters. We are already seeing pushbacks and a lot of trade barriers put up by third countries, and also, frankly, I think part of the surging export that we see in China from last year is because a lot of importers in other countries are front-loading Chinese shipments in anticipation of higher tariffs imposed by the U.S. So, in any way, this record high trade surplus is just not sustainable, and it also undermines China's credibility as a responsible global power. And I think China realizes it, but it's just very difficult to raise domestic demand substantially in the short term. And they still, China is still an ambitious country. It has ambitious goals for its economic development. So for the time being, I think China will probably continue to rely, unfortunately, on external demand to sustain its economic growth for probably some time.
And I mean, the challenge for, let's come to Europe for a second then. The challenge for Europe is not only that the competitiveness of China in some of these modern and newer technologies brings in more exports into the European economy, but also the European exporters, for example, in cars, have a much tougher time selling stuff in China because they're behind on autonomous driving, for example, or on EVs. So for Europe, that is obviously an issue. But and for our audience, we decided to kind of divide up the big economies among the three of us. So I'm going to talk about Europe for a second. Europe, in a way, is trying to maintain its open economy that they're used to, right? They're committed to global trade, and now they're being hit by the Chinese exports that displace a lot of demand for European goods, but also they're squeezed by the US trade policy, so they're really kind of in the middle. And on top of all that, you have the geopolitical concerns in the east where the Russian aggression is demanding attention. So as I can see it, there is a good deal of optimism despite all that in Europe. We earlier had a discussion here at the Atlantic Council with Rolf Strauch, the chief economist of the ESM. And he pointed out that there is growth returning. Stock markets and financial markets actually are quite, well, I wouldn't say booming, but they have been increasing more than the American stock market. The exchange rate is up. So there are some signs of reshifting of investment into Europe. Also, asset managers report very strong demand for bonds and the like. While, of course, they decided to increase defense expenditure. And that's slowly coming. That will also be, I think, a factor in medium term. So that doesn't mean that Europe is not exposed to an intensification of trade tensions. And I mean, we can discuss whether the Chinese US trade dispute that hopefully will be resolved at some point will really impact Europe as well quite a lot. But at least with the US, I think there's some certainty after the latest trade accord. And if nothing else happens, then I think they should be able to cope with that. But again, Europe also has the problem with demographics, like you mentioned in China. I think it's not as bad in Europe, but the population is aging rapidly. It's a big fiscal burden. And it could be overcome if there's a strong push to boost productivity. But we just don't see that type of investment that's going on in the US right now. In Europe, there is a lot of investment for sure, but it's not these massive projects. And you know, if AI and financial technology turns out to be the productivity and growth producing engines that the US hopes, then Europe will be quite badly behind in some of these areas. Reforms to the European economy are slow. We're still talking about a banking and financial markets union that now is called the Savings Investment Union. There are some signs that, for example, Germany is more open, for example, with the common European bank regulator. And German Chancellor was just proposing a European-wide stock market, I think overnight, which is quite remarkable for Germany. But people are not expecting this to be completed next year. They're expecting it maybe to be completed over the next 5 years. And the baseline is more, well, we'll take another 10. And that is really very long compared to what's going on right now, right? That very strong structural shift in the global economy is something that Europe has more difficulties in accompanying. And you also see it still in for example, bank mergers and the like. So Europe, I think, has a lot of technology that they can bring to the table, but the ability to scale that that technology into marketable and profit-making enterprises is still lacking, which is a concern. Europe also has to deal with political fragmentation. It's still mostly within countries. Of course, there's well-known outliers like Hungary and potentially the Czech Republic and Slovakia that have more EU-skeptical governments, but the rest of the European Union is still fairly committed. But in most countries, there is now a strong nationalist element in the votes, and as closer as these get to power, one could expect perhaps less coordination on the European level. I mean, there's the other view, of course, that Europe always will stand together in a crisis, but we hope not to get there in the first place, right? So we'll see how this plays out. But let me ask you, I mean, just off the cuff, if there is no resolution to the US-Chinese trade dispute, if indeed we're going to see 100% tariffs on China and we see constraints on exports, rare earths, some other retaliation. First of all, what do you think, how likely is that? And second, what will be the implications for the rest of the world of all that?
I don't know. You know, the taco, Trump always caves in. You know, it's very difficult to see whether this will or will not occur, because these kind of negotiations become sort of so centered on personality rather than underlying factors. So in terms of the chances, I don't know. In terms of the impact on the rest of the world, I think it will obviously exacerbate various things, including the issue of Chinese exports, since they'll want to export somewhere, and if they're not exporting to the US, guess who? The rest of the world is the only other alternative. I think at present the rest of the world is in a very difficult position because it's caught between the three major economies, all of whom have big uncertainties, potential downside risks. It's caught between a US which is pulling back from being the consumer of last resort, or at least hopes to be, and a China that's, as you say, becoming even more export-orientated. So I think, the general view in the rest of the world is to sort of batten down the hatches and sort of hope you can sort of survive the storm. I don't know whether that's, I think in the end, the US probably will carry on going on, and it probably will continue to be a bit of a consumer of last resort, but, we'll see.
What do you think? Well, the way I see it is, these tit for tat that we're seeing between U.S. and China, they're essentially just building up their leverage in their eventual negotiations, if there will be one. I think eventually, I hope both sides will calm down and come back to the negotiation table, because the Chinese the recent rare earth controls that China announced, it's self-destructive, and it's not just targeting the U.S., it's targeting really the rest of the world. Europe, for example, will be hurt very badly from this, and I think China understands this. But I do think there may be some long-lasting damage done by that. China is obviously learning actively from the U.S. in designing its own export control instruments. But like the U.S., we see once that regime is up, it's very hard. There will be a lot of exemptions. There will be a lot of workarounds. But you see once that regime is up, it's very hard to get away. And it will make commercial ties between countries, economic ties between countries more complicated. Yeah. And I think that's the case for the Chinese rare earth control as well. The regime is there, and it will come into effect even though there will be exemptions, but the damage is already done, and it will be long-lasting. That's what I worry about.
Yeah. Yeah, I mean, one factor I'm sure is the so to speak, the infrastructure of trade, right? The regulations, the restrictions, and as you say, they may be all applied very generously, but they are there.
Yeah.
And they can be applied again.
Exactly.
And that's part of the uncertainty, I think, that we're all kind of dealing with at the moment, right? Uncertainty from trade, but also uncertainty of the structural change that's ongoing. It will probably deepen. And what I found interesting is The Economist had a piece last week, a special report on the fiscal outlook in advanced economies and the difficulties of avoiding continued debt increase because it's so hard politically to reform the public health and public pension systems, right? I mean, we've seen it in France. China has done it, problem, yes, yeah. But you increase China increased the retirement age, and here we'll see. I mean, here I think health insurance is the pressing matter because that's the biggest budget item. It keeps on growing, and we're not sure how this will end. But the point is that with all this uncertainty and with the restrictions in place, the fiscal room to overcome some of these obstacles and to react to crisis is also shrinking, right? Which is a common phenomenon across all the major economies. I think also you mentioned it for China. So how are the emerging markets coping with that? People are talking a bit about the momentum in Southeast Asia being weaker. I mean, Indonesia has issues, Thailand has issues. The Asian tigers of last, they're also reaching a stage where I think they're not growing without bounds anymore. I mean, how do you see the situation and for the developing world? Have they ways to, in a way, create their own growth by trading more among them, or by being more innovative, or are they kind of bound to just sit there and be the spectators in what's going on in the big economies?
Well, if you see the big thing here as this new technology and creative destruction, traditionally that has not been an area in which sort of poorer countries catch up particularly fast. I mean, they can catch up, but they tend to do it after the technology is a bit better sorted and it's clear how to invest in it. So from that point of view, I think the big new impetus is more likely to be the US and China. It's not going to be Europe simply because electricity costs are too high. And it's a very energy-intensive sector.
Yes.
I think raw material producers will also tend to be affected because the demand for sort of old style will go down a bit. I don't know. What do you think?
Well, I think it's a real challenge, as you described, Martin, for many developing countries, emerging markets, export used to be their chance to get richer. Now, with the shock from the Chinese surging exports, it's frankly making that channel becoming more prosperous, more challenging for those poor countries. So it's a real challenge.
Yeah, probably what we may see is probably some increase in fragmentation globally, because in the end there will be partnerships with some of the bigger countries, right? I mean, you look at China and its Belt and Road Initiative, how they kind of tied a lot of countries to them, not only through investment, but also more and more trade, which the US and Europe have been kind of found it difficult to do. And the US is also working with specific countries. Argentina comes to mind, but also others. We'll see. I mean, Europe is obviously very close to Africa. But I mean, I agree with you that the outlook over the medium or long term is well, we don't know the long term, but over the medium term is difficult. The WEO has increased its outlook, but when you look at it closely, it's mostly for this year. It's or next year. It's the correction for the April downgrade after the trade announcements. But I think over the medium term we have to be very guarded. So maybe we need to have this discussion again in 2 years and see where we are then, and maybe a savior has appeared. But thank you very much for joining us. It was a pleasure. And please, our viewers, stay tuned. There's more Atlantic Council programming to come today and tomorrow, which will be then the last day of these annual meetings. Thank you very much.
Thank you.